If you've heard anything about the one big beautiful bill, you've probably heard the headlines. No tax on overtime, a new deduction for seniors, car loan interest is deductible again. And when people hear that, the natural assumption is, okay, so my taxes are about to drop. Sometimes that's true, but most of the time it's more complicated than that. So instead of repeating headlines, I want to walk you through what this law is actually doing and how it shows up on a real tax return, because none of these changes work automatically. Let's start with overtime, because this one is getting misunderstood the most. Beginning in 2025, there's a deduction for qualified overtime income, up to $12,500 per taxpayer. That sounds generous. But here's the part that matters. It's not your entire overtime paycheck. It's only the premium portion of overtime, the extra amount you earn above your normal hourly rate. So if you normally make $20 an hour and overtime pays $30, only the $10 difference is what qualifies. That amount reduces taxable income. It does not eliminate payroll tax, and it phases out once income starts climbing, which means two things happen in practice. First, people overestimate the benefit. Second, they assume their W-2 explains it. It doesn't. This deduction lives in payroll detail. If no one slows down to look at that, the number is either missed or wrong. Now let's shift to seniors, because this one sounds simple, but it changes planning decisions. There's a new enhanced deduction for taxpayers aged 65 and over, up to $6,000. This is not a Social Security rule. It's not tied to benefits. It simply reduces taxable income. But it phases out once income exceeds $75,000 for single filers or $150,000 for married couples. That phase out is what gives this deduction teeth, because now the timing of income matters more. When retirement distributions begin, when income is recognized, even when Social Security benefits are claimed, those choices can determine whether this deduction stays intact or quietly disappears. This is where planning starts to matter more than filing. Now let's talk about car loan interest. Yes, personal car loan interest is deductible again, up to $10,000 per year, but the vehicle has to qualify. Final assembly must occur in the United States, and the loan must be incurred after December 31st of 2024. And income phase outs start earlier than most people expect. For individuals, the phase out begins at $100,000. For married couples, that figure is going to be $200,000. There's also a reporting nuance here in 2025. Lenders are allowed to provide statements instead of full IRS reporting, which means documentation matters. This deduction is real, but it's narrow, and it rewards people who verify before assuming. Here's what all of these changes have in common. They don't eliminate tax. They reduce taxable income. They don't apply automatically. They depend on accurate classification and timing, and they phase out quickly once income rises. This law didn't simplify the tax code. It made planning more valuable. The people who benefit the most won't be the ones who rush to file. They'll be the ones who slow the process down, review earlier, and make intentional decisions before the return is locked in. That's where these deductions actually work. It's important for a tax professional to take a look at this and reassess your tax filing and planning situation with the one big beautiful bill in mind. Click the link in the description to request a tax strategy call. We use a short questionnaire to make sure this is a good fit for both sides. Please like this video and share this to someone who can take away some key points from this video